Eric Mwathe with another mentorship video. And so we're going to be taking a couple of questions that have been posed to me, and I've decided to answer the questions via video, because sometimes typing, or texting back is not the easiest way to answer questions. So we do need visual understanding of what we're talking about, and so I'm going to use the charts to answer a couple of questions that have been posed to me on the mentorship program. So let's take a look first and foremost at a question about how do you time a market when the RSI is, let's say, above 69.1. If you're looking for a reversal, more often than not, when the RSI is making a high above 69.1, that generally is not the high. So let me repeat that. Generally, when the RSI is above 69.1, that is generally not the high. There is going to be another high where the RSI is lower, and then that is the best timing. So, and I think people get confused with this, because everywhere you read about the RSI, it always tends to indicate that the RSI is a measure of how overbought or oversold a stock is, and that forces the mind to make wrong choices, or to think of this situation in a wrong way. Sorry. What I'm trying to say is, just because the RSI is trading above 69.1 does not mean it is overbought or overbought or extended. It just means it's strong. And yes, sometimes this move above 69.1 does become the high, but generally, and I'm going to repeat this, generally, what you will find is that this, unless it is uniform activity, tends to indicate that the stock is so strong, it is going to have to make another high before you get negative divergence like that. Improving highs, negative divergence. Now, once you see negative divergence, it suggests that from a technical standpoint, the stock is running out of momentum, out of fuel, out of excitement, and so it is going to pull back. So instead of looking for stocks that are trading from a bullish standpoint above 69.1 for a sell signal, what you can do is patiently understand that the stock is more than likely, if it comes to the 50 and finds support and moves higher, more than likely it is going to be making a higher high, so that it can set itself up for a lower low on the RSI and a higher high in the price that eventually leads to a drop like this. So recently, in December of 2014, the RSI did something like that on the NASDAQ, or something like that on the price. Now, if I show you the same time period on the Dow, or the Dow daily, and on the Dow daily, what we are trying to look at here is this high with the RSI above 69.1. When that happens, generally that is not the high. And here's another instant where the market went higher, came down, and then blasted back up to make higher highs, but the RSI made a lower low, and that's the key. So from a timing perspective, the time to short a market or an instrument is when you have this negative divergence, more so if the negative divergence has the RSI stalling around. Remember, it's around, not at 61.8, but just in that general area of 61.8, which is what happened here. Then from a timing perspective, then you can go short there. Not here, because the RSI was above 69.1. So from a timing perspective, not a good idea to go short here. This is not an area where you want to go short. You want to go short after the negative divergence of improved highs, lower technical strength. We go to the same time period, take a look at the S&P 500 daily. And here we see, again, the same type situation. We made a higher high. We made an RSI move above 69.1, which is very bullish, which was this high. And you'll notice even here, that was not the high. So using the RSI when it's above 69.1 for a sell signal is a bad idea, generally speaking. Sometimes, yes, it will give you the high, but generally speaking, that's not a good idea. What you want to do is, be patient, understand that the stock could come back, make a higher high, and the technical strength would decrease, and that's when you can take the bet, calculated bet, that the market could pull back, or a stock could pull back, or a forex instrument or currency could be pulling back. So you need that type of confirmation. So let me switch gears and talk about something else pretty quick here. The inverse is true for a stock that is trading below 30.90, because that generally is not the low, because this corresponds with this period here, and you can see this was not the low. You get the low short term here when you get improving technical strength. So you can see over a period of weeks, the RSI keeps making higher highs, and the price keeps making lower lows. Ultimately, that was enough to generate enough momentum to push it higher slightly. Okay? But also notice here, generally speaking, when the RSI was trading below 30.90, this was not the low. Here, the low stock kept making lower lows and lower lows and lower lows. All right? So you don't want to buy there. What you want to do, the best buy point, as you can see here, the stock did eventually went lower here, which was this bearish period, generally below 30.90, and finally it moved higher. But this move was always going to be fake, because we haven't seen a higher high above 30.90. So you can see this move here above 50 and back below 50 with uniform activity. That was the key. This move with uniform activity back below 50 suggests that the stock is finding it difficult to stay above 50. This move is a trap because of that uniformity. And let me show you something else that you can also observe from this. A couple of things were going on here. There was a break of that trend line, which came off these highs and this massive drop. We just draw a simple straight line there. You can see that the stock was giving a sell signal here anyway. Not only was it giving a sell signal, there was also another signal from this break, which corresponds with this break somewhere here. Draw a straight line, and you can see uniform activity above this line and back below it, which is a sell signal. It is only recently that we see the stock coming back and making lower lows, but the RSI making an improved higher high. So this positive divergence is the reason why it's had a nice move from, let's say, from 12 to 14. Is this the end? Probably. Why? Because you can see that the instrument has come back to where it had struggled previously here. So this is almost too simple, but we never want to be too arrogant and say that the market is simple. But you can see that if the market is going to continue doing what it has been doing, then this is where this instrument struggles. And this being a bearish instrument in the financial space suggests that the general market and the financial sector should be back in play after recent pullback. And so even as we see here with the markets trading higher, maybe that's why, because this instrument are turning around and the FAZ is struggling. So as the FAZ struggles, the general market should come in play, because this is a bear ETF. Now, just for the sake of understanding, let's go to the other instrument in the financial space that moves alongside the financial space, FAS. This one moves in step with the market. And we can see that a couple of things here in what we are doing here. Generally, it held above 69.1 here. The exact opposite, which was these highs here, this period of highs here. But that was not the high. The high only came when it made another higher high and the RSI made a lower low. So from a timing perspective, this was a better short opportunity because you had confirmed declining strength. But now if we take a look at the stock itself, if we draw a line connecting the prior lows, and this line has been on my charts going back 1 and 2 years, you can see that this is where this market, FAS, tends to find support and move higher. And how do we know that it is good support? Because of uniform activity. Here we have what looks like a W, uniform activity, which is here. We have a V-type uniform activity there, which is here. Uniform activity below the line back above it, which is this nice entry. Even here there was a kissing of that line, and it kissed it again there. So all these lows were on the line, very successful lows. And again here, uniform activity, well, not very successful, but finally uniform activity looks like a V-type formation there, or a U-type formation there, which gave us these lows. Recently we come and kiss that line with uniform activity, which was here. And as of right now, depending on how the market closes, remember this is midday on this day that I'm recording this video. So if the market continues being positive the next day or two, or even given the chart right now, the assumption has to be, without knowing what the next minute, the next hour, the next day, the next week brings, the assumption based on what you're looking at right now has to be that if this is what is going to be, the chart is going to look like this, then suggesting that more than likely the RSI is going to bounce again, something it's been doing over the last 2 years, and the market should start pushing higher. I hope that makes sense. I want to touch on something else before I go to the second set of question, is how do you time an exit into or out of a stock when the RSI is already trading at 69? So let me go back, for example, to the Dow daily. How do you determine whether this is a place to go long or to go short? Number one, we've established that generally that's not a good idea. If you want to time the market for a situation where you want to go short, you'd rather have evidence of negative divergence where the market itself is telling you it's running out of momentum. And this here is not running out of momentum. So areas like this, you do not find short opportunities. Yes, the market can pull back, and it did from here, from these highs to here. But the problem is eventually there could be another high because of the frequency at which, when markets are trading above this level, generally it's just a sign of strength. So I would say be careful in going short markets that have had the RSI just move above 69.1, or when the RSI is above 69.1. That's a bad idea. But what you can do, if you want to narrow it down, is you have to go to the smaller time frames. And on the smaller time frames, you can see, for example, when the Dow in December was making higher highs on the daily RSI, we had this negative divergence here. So this negative, so you can increase your timing chances by going to the smaller time frames. The Dow was making lower lows, RSI was making higher highs, and that did set up for this short-term view. Remember, you're using hourly charts, so hour to hour, the market did respond to this negative divergence with this plunge. So from this negative divergence here, the market did react with a move lower. So yes, you can use it for a short-term basis. But what happened after that, and we were very aware of this at the time, the market eventually came here on the line where it was finding support and bounced back above that line. Once it moves above that line, it was a buy somewhere here. And what happened is, again, the market comes and makes a higher high here, which was the most recent high, but yet again we see negative divergence. So you can use the hourlies to narrow down on better timing. Negative divergence because of improved highs with the lower lows on the RSI. That was, to me, a better place to go short. Yes, you might say it on hindsight, that's fine, but that's a better place to go short. Just like right now, we can see that recently the market had bounced above this area here for a nice move higher. It came here with uniform activity throughout this period and made a low and a nice move higher also. And we can see here, as of right now, that it is giving us uniform activity below the green line and seemingly back above it. If that's the case, then more than likely, just like the dailies, the market is indicating it wants to go high. Of course, we don't know. At the same time, we have to be sensitive to the idea that, just for example, and for the sake of education, if this green line now becomes resistance, if it now becomes resistance and starts pointing down, then expect the market to actually be under resistance somewhere here and to move higher. The key is whether it stays above the green line or below it. If it's above the green line, it's bullish. Below the green line, definitely is bearish. Hope that makes sense. Also keep in mind and always consider what the MACDs are doing. And you can see here that at least one of the MACDs is back above zero. So if both MACDs can eventually move above zero, then that's your confirmation that you're in a strong market. But here's something I need to stress. The RSI generally, and let me say generally because not all the time, but for the most part, the RSI gives you a better signal way before the MACD does. So keep that in mind. If you are having a confusing analysis between the MACD and the RSI, so let's say if you're having some signals being confirmed by the RSI and not the MACD, if the MACD is telling you one thing and the RSI is telling you another, always go with the RSI. The RSI, if you use the tool correctly, is a better timing tool, in my opinion. So yes, if you're not sure, like on the Dow, remember this Dow period here is when the daily, this is now the hourly, is when the RSI was trading. So that period that I just showed is this period here. And we can see if you combine the daily and the hourly, you could have had this swing trade from here to here. Yes, maybe you might say on hindsight, but the hourly told you there was negative divergence during this period. So this drop made sense hour to hour. And then finally, the daily, the market made another hour to hour negative divergence, and even the daily now made another negative divergence. So at this point, both hourlies and dailies were showing negative divergence, and let me show you that again, which means that this high was a better short because the hourlies were confirming negative divergence and the dailies were confirming negative divergence, which predicted this drop that we've had over the last couple of days, which makes a lot of sense. Okay, so let's go to part 2 of this video in a way of analysis, and I'm going to be taking a look at your picks or the stocks that you own on your portfolio right now. All of them are short. So this is the list of stocks on your portfolio, and right now you can see that you are, because they are short, this is the gain, and I would say you're sitting pretty. In other words, this is good because none of them is even close to losing you 3%. Remember, again, just to stress for those of you who might be watching it later, this is the portfolio holdings, and because you are short, you'd like this to be negative. And since all of them are negative, since you bought them from your short price, this gaining net almost 2.5%. So I don't see anything wrong with that. I would say keep holding, but you have to be careful because if that market on the daily, and so let's take a look at the daily, and I did send you that tweet, and I also send you a private text message to your cell phone, and I was talking about the daily charts on the NASDAQ, because the NASDAQ is number 1, holding the previous breakout level there. That seems to be holding, which is to me indicating possibility of a bounce higher. Of course, this day has not ended, so we have to be careful in assuming that this is what the day is going to be looking like at the end. We need the daily closing because the daily closing is more important. And the best way I can summarize why the daily close is important is like it's the end of the game, and the scores at the end of the game are more important than the halftime score. Okay, makes sense? So the close is what is more important, not what the market is doing during the day. And the market has been bouncing on this line, as you are very aware. And you can see here uniform activity below the line and back above it, suggesting that this could be an area where the market could bounce, which could suggest that your shorts could start struggling. Okay, we also take a look again at the Dow, just to kind of, and we see the same thing. This is where the Dow has been finding support, and you can see you are not the one doing it, I'm not the one doing it, but the market seems to be bouncing on that line. Okay, which means that the general market is going to start moving higher, more than likely, and also that this prior high is being tested and the breakout is holding, there. So that seems to be support, and the market did find support there. So the indication here is that the market could move above the 50-day moving average and start pushing higher. Is it going to go to new highs? I don't know. Of course, we'll have to see. And then we take a look at the S&P 500 daily. Same thing. This is the last line of defense on the S&P 500. Recently, going back to February 2014, this is where the market has been bouncing with uniform activity. Every time successfully. All these lows have been successful. And even recently here, successful low with uniform activity, and now uniform activity support. So the S&P 500 is indicating that more than likely this market could move higher. And if the market moves higher, generally, it takes everything higher with it. And so that's just one thing I have to say. The portfolio looks good right now. Those positions are good. But if you take a look, for example, again at the VIX, you'll see that it is struggling at a line that it's been struggling over the last 2 years. So this here is a problem for the VIX if it continues behaving like this. And also the fact that it is now pointing down. More importantly, honestly, is the RSI there. In fact, if you take a look at the VIX ETF, or the ETF that tracks the VIX, you can see quite clearly that it's been struggling on this line. And as of right now, this is becoming a sell signal. Recently, there was another sell signal here, on and on. You can do this on all this. All these highs coincided with this line on the RSI showing uniformity resistance. All of them, without fail. All of them. So we have to assume, without being emotional about this situation, that this market is telling us that this is where the VIX struggles and the general market comes back in play. Very important distinction there. So we have to be careful with our long positions. In fact, let's take a look at the hourlies now, because we want to narrow down and see what the hourlies are doing. And you can see I spoke about this the other day, I believe it was yesterday, that the VIX has been struggling on this level. As you can see, it struggled on that line. Once it moved below that line, that was a sell signal there. Once it moved below here and struggled, that was the high there. And it's found resistance here, which was also this high. So the VIX is also indicating the possibility that the VIX goes lower and the market goes higher. Okay, want to take a look at the general markets from a short-term view, which is the 60-minute. And I had not looked at this prior to recording this video, so I'm going to do this on the fly. The Dow, we are very sensitive and aware of this fact that the Dow had broken above these prior highs. This prior line was on my charts going back to October. During this line made a high. Once the market broke out here, was this nice gap up, and from there the market just went crazy. I mean, went crazy to new highs, new all-time highs. And from experience, we know that we take that line and extend it. As you are very aware, but this is an educational video, so I'm going to have to touch on this. Every time the market has come and bounced on this line, the market has moved higher short-term, hour to hour. And we're talking about uniform action. Uniformity takes place because there's a reason that I don't know why, that the market seems to respond to these types of uniformity. The market moves higher there. Now this is very confusing, but generally uniform action on each instant. If you take this and blow it up, you'll see that all these are uniform action above the line, back below it, and finally back above the line here. In other words, during this period here, what the market is in essence doing is something like this. It's making all these uniform actions on the line, on this line. It might not seem uniform, but it is. It's doing this. Uniform. It's all uniform around the line. And then finally, bam, which is, it breaks out, which is this. We take that off, which is here, and which is this nice entry. And so all we have to do is extend the same line, and you can see that as of right now, that this is uniform action below the line and back above it, indicating this is a market that could go higher. My only problem as of right now is what would happen if the market moves back below this line. So yes, right now the market is indicating that it is due for a bounce higher, because even the hourlies I've moved above the line with uniform activity. This is uniform activity, looks like a V below the line and back above it. So it looks like something like this. Yes, you're not going to find this information anywhere else, because I don't know anybody else who would have discovered or talked about this. I'm not saying that it is. All I'm trying to say is that it is hard to find more information on this method because it's my method. And so I understand it better, is what I'm trying to say. Anyway, and again, the MACDs are not both above zero. So, of course, the market never gives us one opinion. It always has many opinions. But we can see here is, for example, if the MACD stalls at zero, if the MACD stalls at zero and starts moving lower, and of course on my settings I have two MACDs. Why do I have two MACDs? I have two MACDs for one reason, and that is because one of them gives us an early signal and the other one is of course the default MACD. So I like to use the smaller time frame MACD, and sometimes the number might vary, but they're going to be pretty much around 5, 8, 3, and all these are Fibonacci numbers. Or the one I also like to use sometimes is 21 and 8. Again, all of them are Fibonacci numbers. So I use two MACD settings just because one of them tends to be moving faster and gives us an indication of what could happen next on the main MACD. So anyway, that's the view there, that yes, the market as of right now, without any more information, you have to assume wants to move higher, which might bring the stocks that you own, like GE, which we had gone short earlier, because we see that it is very close to moving to 34-month lows. That's why GE is a short for us and has been a short for a while, because of this move to 3-year lows, which is bearish. And we can also see that the MACDs on GE continue to be moving below zero, and at least on one of the MACD, the faster time frame MACD, is also making a 3-year low, which is bearish. Now I took a look at the daily here, and you can see that if you consider this low and this move, on hindsight, this move began when it moved above that line. On hindsight, we know that for a fact, that ever since that move above there, the market moved higher. So we use the stock itself to learn how to treat any subsequent situation. So we draw a simple straight line and look for uniformity. Lo and behold, triple bottom there, uniform activity, touching the line and bouncing, generated this low. Okay, now yes, in truth, if you go here, it's very hard to time this entry to the last penny. Why? Because you don't know that it's gonna bounce once and move higher, or it's gonna have a double bottom and move higher, or like in this case here, have a triple bottom and finally move higher for a swing trade, which moved it from here to here. You don't know that. At this point, you don't know that. But what you can see that on hindsight, that eventually did move higher. My point is, whenever you have that type of a situation, you are better off, and you should always do this. We should all of us should always do this when we are looking at opportunities like this, is consider what the 30-minute chart is doing. Okay? And also consider what the hourly is doing. And by doing that, by going deeper into the smaller time frames, then you can help you time this entry if you are looking for a bounce. But on this daily chart, you can see that it has bounced on this line once before, again with uniform activity below the line back above it, which was this nice entry point. Now in this instant, it did not bounce twice or 3 times. It was one bounce on the line and moved higher. So you can use the 30-minute chart and the 60-minute chart to time this entry here. Sometimes you'll be successful, sometimes you won't, but that's just how the market is, and that's okay. Okay, and that was good enough to take the stock or take GE from this range here all the way from here to here, which is a nice swing trade. Let's bring our line back because you can see what I'm getting at already. As of right now, with the market looking like it wants to bounce. Let me draw this better. It's slightly above here. You can see that GE is bouncing at the line. It is also bouncing at 30.9. It is also bouncing at 30.90 with uniform action. All right. Now, that could suggest that it could move higher. So all you can do is maybe you can use the high for the day as a stop, which is this high there. You can use the high for the day as a stop. If it moves above that, then maybe this market is truly taking off. Otherwise, right now, your position on GE is doing well. Let me show that. Your position on GE by itself here seems to be unchanged or down about 0.41%, which is okay. So you can still let it move a little bit. Maybe 3% would be your maximum, something like that, maybe 5%. While I am on this chart, I want to touch on something pretty awesome, I think. And you can see here this idea that when a market makes uniform activity above either, and I've touched on this on other videos, uniform activity around 30.90 or the other, which is 69.1, uniform activity on either of these lines tends to move the market and change direction. And here's a good example. Uniform activity above 69.1 and back above it was a high there before the plunge. So this is some of the exceptions when you are using this RSI above 69.1 as a sell signal. If you get uniform activity, maybe that might be some of the few instances where you get a high, and that was in this particular case. We kissed that 69.10 with uniform activity, which gave you a high. We came here and had resistance at 69.1, which gave you a high again. Also, uniform activity below 69.1, and again uniform activity below and above 30.90 this time. So uniform activity at 30.90. Let me show that again. Uniform activity below 30.90. It does it again. So two back-to-back uniform activities eventually gave you this low. And of course, we can see the market had a chance of moving higher. Uniform activity at 30.90 gave you this low, moved higher there. Uniform activity at 30.90. And again, we can see that there was this move from here, very successful swing trade. Uniform activity below 30.90 and back above it. Entry point there for a nice 1 week rally, for a couple of points. And here, looks like it wants to do the same thing. Okay, so that's all I see there. And since this is educational at the same time, take a look at the MACD, because on the MACD series on my channel on YouTube, once you have an established trend line, like we had an established trend line from this low connecting to this low and this low. Once we broke below that, you can see that the stock did drop here, but the stock comes back above that line extension with uniform activity. So this is uniform activity below the line, back above it, which means, according to what we learned on the MACD series, that this crossover below zero is important, and that's why the stock moved from here to the highs, which you don't see on the chart, but the higher highs to about 26.75. So this, you can see that the MACD principle here was useful. So again, this crossover was a good crossover because of the principle we learned on the MACD series. In fact, if we take a look at the other MACD, we can see that the same thing. We had this break, and so once you have a trend line break, the next MACD crossover tends to be more successful, and it happens to be this low here. And so let me show you what happened after that. So the lows on the MACD here led to this move. Whee! All right, so the MACDs also do come in play. Now, for the sake of just making this video relevant, let's take a look at the hourly. As you can see right now on the hourly for GE, there's a problem because This here, even though it's uniform activity above 0 or below 30.90 and back above it, could suggest lower prices. Or because it's uniform activity, it could suggest that this market has made a low short term. I don't know which one, we'll see. Only time will tell. But there's a way you can help yourself in finding out. Is you see this break, this small break on the hourly for GE, there's a lot of information there. This break on the short-term basis can help you time an entry into a position. That break happens to be this move here. So all you can do is, and it's very simple, draw a straight line. If GE continues staying underneath that line, it is bearish. Hope that makes sense. The more it stays underneath that line, then your position is safe. But if the dailies are looking good and the hourlies finally move above this short term and the dailies are looking good, then you have to conclude that the market could take off. That's why I'm saying use the high for the day as a stop, which would be the high if the market moves above that. Use that as a stop. And so you are in the position, knowing exactly when to get out. No need to panic. If it works out, it works out. If it doesn't work out, on to the next trade. Let's take a look at the other position you own, C and Q. And all these are short opportunities. This is great. I love this. This is awesome. Why? It's breaking down below this recent weekly closing low. This is a great and doing well for you. And it's great. Great to see that. And we can see that the stock was looking bearish ever since it crossed over here. In crossing over there, that was bearish. The 13-week moving average and the 34-week moving average. So that crossover between the 13-week moving average crossing over the 34-week moving average. Remember, also, these are Fibonacci numbers. That's why I like using them. 13 and 34 are Fibonacci numbers. That's why we use them. And this crossover was bearish, so the stock generally is trending lower. This was bullish, the crossover between the moving averages, which is generally, this was bearish. Crossover bearish. This was bullish and led to a move higher. So even the crossovers were indicating a stock that was in trouble. You can also see that if we take a look at the 3-year monthly, this is where you can see clearly that now we are trading at 3-year lows, which would indicate why momentum is starting to peak on the way down. And that's why I believe you are short that instrument. We can also see that the other MACD, or at least one of the MACDs, is pointing lower or trading to 3-year lows. And the other MACD has also moved below 0. So that short, in my opinion, makes a lot of sense. And so let's hope that it continues doing well for you. The other stock in your short list of stocks is IBM, which we've been short for a while. And why have we been short in IBM? In fact, I'll take you back even further. Before you shorted IBM recently, for the sake of explaining why IBM has been on our short list, you go back a couple of years, and now you can see that IBM has been bearish ever since this drop, and I remember highlighting this as a short period, which was the highs there. Why? Because the RSI was moving to 3-year lows. Very simple. Let me draw that. The RSI in IBM was moving to 3-year lows at this point. So I knew that was a good place to go short. Yes, it hasn't been the best short because it didn't move that much. It did move, but not by much. Now we see that it is making another low here. This is where we started thinking IBM was poised to go lower, somewhere here. And so this move here makes sense. Not only is it doing that, something else I want to sensitize you to. It's a very simple reasoning. The line that it broke on the way down, it broke this line here and came off the highs here, or 205. Once it broke below here, let's say at about $200, it's been down since then. If you draw a simple straight line like that, the same line, once you extend the same line, it's always good to extend your lines. They have a lot of information. IBM was showing resistance at that point, which was this high, and also came close here with uniform activity, did not even get up there. So this was also another place to go short this instrument. And again, right now making 3-year lows. This is confirmed recently with IBM moving its MACDs to 3-year lows here, which is another momentum breaker to the downside, and another break to 3-year lows on the main MACD. In fact, nice 3-year lows, and also importantly, another move below zero. When the MACD moves below zero, something it hasn't done in many years, that's generally indicating that stock has run out of momentum and is actually looking to go lower. Take a look at IBM from a weekly standpoint. We can see that recently the 10-week moving average has been acting as resistance here, here, and here. So whenever you see an instrument that is finding resistance at the 10-week moving average, it indicates that it is weak. And we can see here IBM continuing to weaken even as we speak. Recently it moved to fresh lows there, which was this gap down. Extend that same line. Line extensions are important, and you can see that it is giving us a sell signal about 2 weeks ago, somewhere here. We also see that on the weekly, which is what we are looking at, IBM continues trading below zero on the MACDs and making multi-year lows on the MACD. And that's why it continues being, and then again this line extension gives us another MACD sell signal. So yes, even IBM continues looking bearish. Now let's just take a look at the daily just for the sake of education. And we can see for the sake of education that it recently broke this trend line here. This break was responsible for the stock coming off the highs. And so we draw a simple straight line, as simple as it gets, like that. And this has turned into negative sell signal because of uniformity at the line there and stalling, also stalling at the 50-day moving average. So lots of bearish situations here. Okay, hope that makes sense. So yes, IBM is struggling because on multiple time frames, the weeklies, monthlies, and dailies, it is struggling also. In fact, and I know this seems awfully simplistic, on this daily chart, if you connect the highs on the RSI without any adjustment, none whatsoever, obviously connecting this high, touching that high, and this most recent highs, you can see that without being too much of a stickler on details, this was telling you this was a sell signal. Let me show that again. So on multiple fronts from multiple angles, you can see that this was always going to be double top resistance there. And the only thing you have to do when you see that is consider that this is giving you a sell signal. As of right now, that seems to have been the correct way of viewing this stock. Another thing to observe as we continue this educational video, you can see uniform activity above zero on the MACD and back below it. We can also see that once it moved below, once it broke down, here is what I'm trying to say. This break, if you draw a straight line, now becomes resistance on the daily. So not only are you seeing uniform activity above zero, back below it, which is bearish, you also see the rejection at zero, which is bearish, and also coming back to a prior break level here. And that break level is at the same level where it is stalling right now. So on multiple fronts, IBM continues being bearish. Of course, you always have to have stops in case markets change direction. The other one is LVS, Las Vegas Sands, which we have been short throughout this period here. We've been short that name, and it's very simple why. In fact, if I take a look at this weekly chart, you can see that we have bearish crossover, as we have seen, between the 13-week moving average and the 34-week moving average. So that crossover there, bearish. So it just makes sense that the stock should continue struggling. We also see that now the 10-week moving average has become resistance. And as the 10-week moving average becomes resistance, this is where generally the markets will stall and push an instrument lower. But the reason why LVS
Las Vegas Sands has been a short. The reason, and the main reason, is because the RSI was always looking like it was looking to go lower to 3-year lows. We were anticipating this move to 3-year lows. We were also anticipating the RSI on the monthly chart. Okay, so this is a monthly chart. We were anticipating the RSI to move below 50. It is in moving below 50 that instruments tend to pick up their momentum. You can see this 1 month move below 50. The stock did quicken its move below 50 level. And we can see that if we play it right, what we've been doing, that by going long just before it crosses 50, we are able to have some of this alpha to the downside. And I believe that's the first time I've used that word alpha ever in a video. Anyway, whatever. Alright, but that's funny to me. Alright, here we see that the MACD is breaking to 3-year lows, ultra bearish on this monthly chart, and the other MACD is just about to make another 3-year low. All that seems to indicate is that it is very easy to see that Las Vegas Sands could be trading even lower over the next couple of months, especially if the market is not bullish. Take a look at Amazon, which we've been short, and it is very easy to see why. Once Amazon moved below 305, I believe was the price, 305, which was this monthly closing low, we've been saying that the stock is a short. We say it's a short because it is moving to 3-year lows, which is ultra bearish, and that is a minimum requirement. 3-year lows. We are also anticipating that as it moves below 50 on a monthly time frame, we are going to get some more thrust to the downside. So it's meeting our minimum requirements. And if we take a look at the MACDs are perfectly situated for an instrument that could potentially, remember, there's no certainty, but potentially have the higher odds of continuing to move lower. You'll see that also the other MACD, the smaller time frame MACD, is breaking down again, fresh breakdown. And we can also see that the MACD, the other MACD, this setting, is finding resistance at 0. Every time it tries to move above 0, it finds resistance. So there is the indication that, in my opinion, IBM struggles. Okay, so I'm going to leave here just for the sake of reference that the market is off its highs, but we keep in mind that the dailies could very easily continue showing buy signal on the market. Otherwise, if the market turns down and this is not uniform activity back above our line, then if the market is trading underneath that line and fails to hold above that line, then the market continues with the most recent pullback. Okay, so that's the key. It needs to be above that green line, otherwise it could stall. And if it finds resistance and fails to move above the green line, then the indication is that the market is faking people and could eventually move lower. The one thing I have to premise here is keep in mind on the backdrop. The backdrop is we made higher highs in price, and then we made the lower lows on the RSI. And not only was it negative divergence, it was the worst type of negative divergence. Why? Because the RSI failed to move above 61.8. So it would make sense if the market turns and goes negative, because today is FOMC minutes being announced here in about, let's see what the market is trading. So the FOMC meetings is about to be announced here in about half an hour. So if the market turns down, closes down for the day, this daily chart is going to look different, and probably the market, if that takes place, breaks below support there. So breaks below this support line. So let me draw that again. So let's go through this. If the market does not hold about this bounce and breaks down, then your shorts should do well, market should struggle. If the market does bounce on this line, it's bullish. But if the market fails and stays underneath the green line, added with the fact that it is below this line and the fact that it made a higher high with the lower lows and the RSI failing to hold above 61.8 during this high, then the market is going to be in serious trouble. That's what I'm thinking. If we take a look at the MACD here, And just to show you how crazy it gets sometimes for me, I have 3 MACD settings here. But they are all pretty much the same. But I have 3 on this chart. No biggie. The one thing I want to say is, if the MACDs fail to hold this line here and move below 0, just like the other MACDs below 0, then truly this market is in trouble. But remember, I said whenever there's a confusing views either from the MACD or the RSI, we're going to use the RSI. Right now, without knowing what the future brings, if this is uniform activity back above that green line, then the market is due for a bounce. Remember to use your stops. Anything at 5%, 8%, 3% is a good place to consider placing your stops. Eric Muade, good luck, peace, and blessings. I am out. Woo!